Hi, and welcome to the Outlook for Muni Bonds and how to play them with ETFs, the latest in a series of educational webinars developed by IndexUniverse.com. I'm Matt Hougan, Global Head of Editorial and President of ETF Analytics at IndexUniverse, and I'll be your host for today's webinar. I'm very excited about today's event, as Muni Bonds are front and center in the minds of many investors right now, and ETFs are front and center in the minds of Muni Bond followers. The format for today's webinar is very straightforward. This is the latest in our series of alpha-beta webinars, which follow a simple format. First, we bring in a leading macro thinker in an asset class to give an overview of the outlook for a given market. Today, I'm pleased to be joined by Matt Fabian, Managing Director for Municipal Market Advisors, the leading independent strategy, research, and advisory firm in the tax-free muni space. Matt will speak for about 15 minutes on the outlook for the muni market. After that, I'll jump in with my own thoughts on muni bond ETFs and the things you need to know before you evaluate and trade them. As a participant in today's webinar, you're invited to ask questions of either Matt or I during the panel using the Q&A toggle on your screen. Please don't wait until the end of the webinar to ask us questions. Just enter them in as they occur to you. We'll collate them throughout the presentation and answer as many as we can at the end. One last bit of housekeeping. A few days after this webinar, we will send you an email with directions on how to view a recorded version of this event, including how to download and access the slides. That email will also contain information about how you can earn CE credits for attending this presentation live. With that, I'll turn it over to Matt Fabian of Municipal Market Advisors for his outlook on muni bonds.
Thanks, Matt. Thanks very much, and thanks everybody for calling in and listening, and thanks to Index Journal for hosting this. I think it's just really a perfect time to be talking about the municipal bond sector. We have been in the center of the news for some time, really since the beginning of the financial crisis, with the downgrade of the bond insurers and the subsequent and very closely correlated collapse of the auction rate securities market. And we really haven't left. And frankly, the way that states and cities function, the way that they tax their tax bases and spend their money, we're probably going to be with some kind of media focus on budget difficulties and financial difficulties and worry about default in the municipal sector for a very long time. Just as an illustration, the National Governors Association they have a very excellent piece on their website, nga.org, where they talk about the lost decade for state revenues. And they're talking about it, they published this in 2010, and it's a forward-looking piece. So 2010 to 2020, a very difficult time for state budgets. So it's, up to this point in the recession, it has been a revenue problem with, revenues dropping away precipitously. But, starting next year, it really transitions into more of a spending issue where, the states are going to have to, on one hand, repay all of the one-time borrowings and gimmicks that they used to balance their budgets over the last couple of years. Two, accommodate the new federal mandates through the health care law and others. There's a dramatic increase in the state cost of Medicaid over the, which really spikes in 2014. And then just, getting back to trend with regular spending. The country's population continues to grow. So even if you're trying to keep spending flat on a per person basis, or flat on a per person basis, there are just more persons. So there's more spending. So this is going to be continually pushing cost savings down to the local level, and it's going to keep ratings, bond ratings fluid, if not negative, over the medium term, which is 5 years at least, and probably continuing pressure on municipal bond investors to understand credit quality, to understand what's in their portfolio, to know what they own, the kinds of risks that their investors are exposed to. And it makes direct investing, frankly, a substantially more difficult enterprise. At the time when, I don't think anyone is talking about increasing sales commissions for the direct sales of munis. So I will get into my slides in just a minute, but I think that is, there's one thing here which I think is important. When you think about where you're bringing your clients and how you invest them in the sector, because while we don't think that the municipal tax exemption is necessarily under fire now, it will be discussed in Congress, but there's so much support for it, it's hard to see it actually going away. But the value of other tax shelters will be diluted. Income tax rates are probably having to go up at some point. So the value of the exemption and of the municipal product will increase. At the same time, the broker's compliance costs are so much higher because you're responsible for understanding the individual credits in your client's portfolio, and with the new FINRA initiatives, you have to first make sure that before you put a bond into a client's account, understand, or make sure that the client understands if there's been any kind of material events that could impact the credit quality. Some of the firms are going far farther than that, and making sure that individual clients receive every material event disclosure notice about every single municipal QSIP that they own, putting a real burden on individual brokers to understand that information too. And all of this will lead brokers into more managed products. Just like the ETFs, mutual funds have had a hard time over the last 6 months retaining assets. ETFs, because of their lower cost basis, I think are going to be one of the very viable ways that people will put retail dollars into the municipal sector. So it's something to really think about and consider, and as sort of a means of managing those increased compliance costs, for your own customers. So just to get into the slides here, the municipal bond market has had its fair share of troubles. I think that we're focusing here on just things that have happened, over the last 6 months or so, where municipal credit quality has really come under fire. The municipal industry, we're almost sort of like the Amish, and if there's any Amish on the call here, I don't mean to offend anyone, and it's not a disparaging, relationship. What we're saying is that there's from the municipal, in the municipal market, you're either within munis, so you're sort of in the sector, or you're an outsider, right? So there have been a lot of outsiders, sort of meddling around in our business. We call them strafing, right? Coming in, making some pronouncements about munis and then flying away. We had Jim Chanos starting, back in November, and with him talking the famous short, there's also that, it's not just the weight of what he's saying, but it's also the idea of if he's saying this, maybe there are hedge fund shorters, the feared shorts also at work doing things, below the surface to undermine the sector. Not that there were, but it's the perception of that or the fear of that which amplifies the impact of statements of somebody like Chanos. Then you had, of course, Meredith Whitney, coming in and really taking, what I see as a real personal business risk, making a lot of statements about the municipal bond market, and I don't think she really understands anything about our sector. I don't think she has a firm grip on actual credit quality and how the municipal bond security actually functions. But she did it, and and then sort of following up with that, you had Newt Gingrich talking about state bankruptcy. You have some of the major media sources continue to pursue the idea of getting a Pulitzer Prize. Doing that, that does take sensational headlines and sensational stories to gather, to attract attention. And with munis in the headlines, that has been, we have been the subject. And then finally, it just doesn't end, with the new bond king, this Grunlock guy, talking about how munis are also headed for disaster. And there's been a host of other people who have come in and chimed in and talked about munis. Could we see the next slide, please? So and this has led to price weakness. Now the muni bond market really started in. You have to sort of take it in the context of the Build America Bond program. Build America bonds were taxable, heavily subsidized bonds that were created by the ARRA federal stimulus program. And because the subsidy was so generous, most longer bond, higher rated issuers in the muni sector chose to go the way of BABs. That created a extreme scarcity of tax-exempt bonds over the summer, last summer, and led to higher and higher prices. Excuse me, as the bonds that were available were continued to be bid up. Now that created it was artificially high price levels, artificially low yields, and that became unglued starting in the fall, when primarily it being sort of the catalyst was this S&P downgrade of the municipal tobacco sector, which, even though S&P had warned that this kind of downgrade was coming, because of the poor cash flows in that sector and the continually extending expected maturity for those bonds, sort of the timing of it, the way that happened, it pushed most of the sector below investment grade, triggered some selling when the market was so thinly traded. There was so little supply in the market, so few bonds, and everything was quite rich because of that. That incremental selling, really just started a chain reaction of negative price discovery. Yields began to rise, forced evaluations down. An awful lot of people had invested in the muni market, not necessarily because of the tax exemption, but because of the strong positive momentum, the price momentum, that the sector had been feeling because of the Build America bond program, because of that scarcity. Once the momentum changed to negative, those chasers wanted to drop out immediately. Then, almost immediately after, Meredith Whitney went on 60 Minutes and talked about how, we have problems in our sector. There were a series of very negative treasury auctions. There was much more worry about inflation. All of these things, induced, if you go to the next slide, all of these things encouraged people who had invested in the municipal mutual funds to pull their cash out. This is a cutoff number here. There's actually the outflows at the right have continued. I think we're at about 30 weeks now, and about a total of $40 billion have left, or 44, excuse me, as of last week, $44 billion have left the tax-exempt mutual funds, which is just about 9% of the assets from when they started that period. So a tremendous outpouring of assets, and especially in the end of 2010, those outflows required the mutual funds to sell bonds in the open market, which really wasn't happy. Municipal bonds don't, yields don't travel well. It's a market that's made to be bought and held, not necessarily traded. So when people try to trade them and sell them in the secondary market, prices can erode very quickly, and yields can begin to rise. So that happened, created more negative momentum, created more selling. The selling has since then slowed down quite a bit, or at least the outflows, and to a large extent the mutual funds have been able to pay for those outflows with redemptions, right, with the principal and interest payments that they receive from the bonds that they have invested. They've been able to use that money to pay for outflows rather than selling bonds, which is better, fundamentally for the funds. But at the same time, you're probably going to have a continual leaking of assets out of those funds for some time. A big part of it is what I talked about in the first 5 minutes, where the municipal bond market has become, or I think there's a greater perception of the complexity of our sector than had been before, right? The muni market has operated for a long time under the assumption that munis never default, and that everything is AAA, and that and that it's a fairly plain vanilla market, which was really never true, but it was seen to be true. And now with this financial crisis, with the downgrade of the bond insurers, and with everything else that's happened, that sort of cover has been torn off the market, and people realize that munis are, from the investing perspective, it's a harder lift. There's more, a worry, units of worry per dollar of return, I think, than people had bargained for. So, that means people will begin to, continue to remove assets from the sector, or at least at this retail level, and those outflows, will probably continue, for at least the next 6 months, I'd say. Next slide, please. And just to show, to show the yield comparability here, this is the increase in yields because of mutual fund selling, and you can see the latest period on the right, 157 basis points increase, which compares, it's as big in general as almost every other shock period except for 1980s. When there were some very severe increases in yields, but that was mostly driven by inflation at that point. Next, please. So since then, municipal supply has recovery has been better. Prices have been stabilizing since the beginning of the year. In part it's because the mutual funds no longer need to keep that selling pressure up, but also in part there are just levels. We are in the end a nominal yield-driven market. So if there's a certain amount of interest available, if you can get a 4% at a 10-year or a 5% at the 30-year, in general, investors want to own munis at those levels. So as yields in high-grade bonds have risen to about those levels, buyers have emerged and helped to stabilize prices. But the demand and the focus has been on high-grade, AA and better, and generally shorter bonds, which creates wider credit spreads for everything else. And which is fair because people are trying to manage the cost of credit research. But it does create disparities in the market. Issuers who had access to the market at sort of similar market levels in the past no longer do, and riskier issuers are paying more of a credit penalty than they had before. Again, wider credit spreads, inconsistent liquidity for things which are not high grade. It creates an overall choppier market. Go to the next slide. So it's an overall choppier market, and there has been diminished trading volume as a consequence. Just a few quick slides here, so I can finish up my opening remarks. But just about credit quality. The thing is that these fears over municipal credit are largely overblown, and there are defaults ongoing in the municipal bond market. There's about $9 billion of outstanding muni bonds right now which have an uncured payment default, and that's out of a total universe of about $3 trillion. But there are always defaults in the municipal bond sector, right? As you know, there's an enormous diversity, variety in the sector. The vast majority of bonds which are in default, there's about 250 bonds which are in payment default right now. The vast majority of those are non-rated, land-secured type financings, land subdivision speculation, a lot of them in Florida, but also non-rated nursing homes, non-rated multifamily housing. If we could go to the next slide. I think we show this here. Just one more ahead, I'm sorry. Here you go. So here are the bonds which are in default. $8 billion here at the top. It's actually closer to $9 billion now. And so these are bonds where we say default. That column, the third column, is payment default, and that's actually bonds where an investor has missed all or a portion of principal or interest. But you can see the kinds of sectors are there. Generally we call them the risky sectors, where there is some presumption of default risk when you buy the bond, like a hospital or a tribal deal or a retirement home, as opposed to a GO or a water sewer or a public university, where there's a very little risk of default, and we only have a couple of those, where there have been payment defaults so far. We actually, MMA started capturing this data from the MSRB. Specifically to know, are defaults happening within safe sectors? And to this point, there are no GOs in payment default. There are no, regular, those regular kinds of bonds. Even these two safe sector bonds, which show in default at 28 million two transactions. One of them is a very weak tax pledge it's actually not a general obligation. It's not something like that, but it's a much weaker version. And the other is a sewer bond that was a loan from the state of Wisconsin. So they're not really regular muni bonds, and both of them are non-rated. So far the sector is holding up very well. And if you go back one slide, please, but talk about, in general, we are pretty comfortable with the idea of no systemic, called municipal collapse, no sweeping defaults. Munis generally, lack the refinancing pressure that the sovereigns do, like in Europe. Debt service is 5 to 10% of spending, so a default doesn't save cities or local governments that much money, versus the cost of having done so. Again, right there you have the limited benefit from actually defaulting, because you're only saving a little bit of money, but yet you'll be paying a market penalty and hefty litigation costs for years to come if you do default. The analysts over the years, we have been beaten up in the industry about, Rubini called us Pollyannish, and others have called us conflicted and insiders and muni bulls. But the fact remains that nobody fears municipal credit defaults more than municipal analysts, and we have been structuring transactions for the last 50 years, exactly for a scenario like today. Making sure that, for example, right, we were talking about this today, the U.S. Treasury. The U.S. Treasury, we were talking about hitting the debt ceiling. The Treasury is unable to distinguish between different accounts receivable or between different accounts payable. So if the Treasury runs out of money, it is unable to say, we'll pay Treasury bondholders and not somebody else. It can't steer money one from the other. So in a sense, the state of Illinois has a stronger security, because the state of Illinois has a clear priority to GO bondholders, and actually reserves debt service a year in advance, for GO bondholders. So there is a clear payment priority for GO holders at all of the states and for many of the cities that even the U.S. Treasury doesn't have. It's things like this that we have built into our sector over the years to make sure that munis are fairly insulated from revenue declines and a default risk. We have the next bullet, flexibility by states to set revenue and spending targets. The states are much more sophisticated in their management over the last, in my career of 15 years in the sector, there's been a tremendous improvement in sophistication. Never mind what's happened over the last 50. And then finally, the kinds of structural protections actually that I was just talking about with, Illinois, for example, sequestering the money a year in advance. The very famous California, paying bondholders before everybody but education. And actually, California is, maybe among the weakest of the states in that most states give bondholders a first priority of all state revenues, defined by either the Constitution or state law. So it's a very strong security that most municipal bondholders have, and it really begs the fact that how actually could those happen? Those defaults happen. So here, access to the capital markets has been more difficult for smaller issuers, especially because underwriters have less of a profit incentive right now. We go to the next one. Next slide, please. The narrowing demand, what it means is the muni market was able to bring an awful lot of issuance over the last decade because of a number of things, bond insurance, derivative transactions, and also leveraged demand vehicles like tender option bond programs that were run by dealer proprietary desks and hedge funds. Those have gone away. So now we may be looking at a issuance calendar similar to 10 years ago, for the foreseeable future. So, my firm is projecting 200 billion of issuance this year. We could be at somewhere close to that going for for the next 3 or 4 years. Next slide, please.
Matt, are you still there?
Oh, sorry about that. I put myself on mute while I was coughing here. So we're showing here less trading, in the overall sector, and less trading means more limited price discovery. More limited price discovery means people are more worried about putting their capital at risk, so they're requiring higher and higher yields, causing spreads to widen. And I think the final slide. We can just go through this. This is a little too much. And then I guess so finally we're just talking about Washington here, and we're all in the municipal sector. We are very focused on what's happening in Washington. There is some talk about threats to the tax exemption, as I began with, but also other sorts of structural and regulatory reform around the municipal sector continues to be very important to us. You talk about tax reform, and that's a fundamental change to the muni market potentially. The current credit displacement, that's a cyclical thing, and it will get better. But when you talk about tax reform, the muni market lives in a loophole, and we need to make sure that stays around. But I think we are optimistic that it will be, but it's still something to be tracked very closely. So I think there's one or two more slides here, but I'm going to conclude my remarks, and we can go to questions.
Great, thanks, Matt. That was very helpful, and I'm sure we do have a lot of questions from the audience. Some are already coming in. I'll remind people to enter those questions into the Q&A session. We'll collate them and answer them together at the end. I did want to jump into my slides. My part in this webinar is to approach the ETF and beta side of the analysis to help people understand, once they've followed your kind of analytics and made a decision to move into munis or not, or move into a particular part of the muni market or not, how they do that with ETFs or other structures. So to do that, I'm going to go back a bit and start at the beginning, because I think the structure of the muni bond market contributes heavily to both the pros and cons of muni bond ETFs. So we'll just do a few basic slides and then dig right into that. First, essentially just what is a muni? I mean, you covered this in general, Matt, but a muni is a debt obligation of states, counties, cities, and special tax districts. One important thing to note compared to, say, the stock market, which has 5,000 listed securities, is there are over 55,000 different issuers of muni securities in the U.S., with more than 1.3 million individual bonds outstanding. So there are a lot of choices, and we'll see how that plays out in the muni bond market as we go through. Obviously, just some basics. What can munis do for you? The primary advantage, of course, is the exemption from federal income tax, assuming that holds. Sometimes there is exemption from local and state income tax as well. I think most people know how this works, but the 1-second reminder is here, right? Imagine you're choosing between a corporate bond paying 6% and a muni paying 5% and trying to decide which is a better deal. The corporate bond payouts would be taxed at income rates, and suppose you're in a 25% tax bracket. While the corporate bond might pay a higher headline yield, the after-tax return is actually lower, 4.5% versus 5% for the muni. So that's the gist of why people buy them and find them interesting. Obviously, the higher up the tax bracket you are, the better off they are for you. I think before we dive into the specifics of the ETF market, I do think there are a few, just to lay the groundwork, key features of understanding ETFs, which Matt touched on, that I wanted to go through. Sort of three: the repayment source, underlying credit, and specific tax treatment. So the repayment source, as indicated earlier, is critical. The two most common types of bonds are GOs and revenue-backed bonds. GOs are supported by the taxing power of the issuing entity, say California issuing a bond to be paid out of general tax revenue. Revenue-backed bonds are paid through revenues generated by a specific project or utility, say a bridge with a toll. They do differ in their credit quality, and I think both that level of analysis and analysis of the general credit underlying the muni is critical. The second element to consider is credit modifications, which we didn't discuss much. Some muni bonds are insured to attain a higher credit rating. Others are pre-refunded, meaning the issuer secures the outstanding debt with treasuries that pay out the exact cash flow remaining on the debt. and the difference of this will certainly make a difference to the long-term safety of your portfolio. And then finally, on taxation, not all munis are entirely tax-free. Some are subject to the alternative minimum tax. Others are taxable at the state level if you don't live within that state. And some, such as the Build American bonds that Matt mentioned, are fully taxable, and they incorporate a higher payment to reflect that. But where we really get into the ETF analysis is starting to think about the muni bond market. And the key thing to understand here is that the muni market, like all bond markets, but perhaps works worse, just works differently than the stock market that we all know and are familiar with. So unlike stocks, which are exchange traded, munis are traded through dealers. In other words, whereas you can type the ticker of IBM into Yahoo Finance and get an agreed upon price, it's not possible to do the same thing with, say, a New Jersey Turnpike bond. All price quotes and trades are handled on a bespoke basis in the over-the-counter dealer market, and the end result is less transparency and efficiency in the market and imperfect price discovery. I'd also note that the muni bond market is dominated by large buy and hold investors such as institutions, pensions, and insurance companies. And many individual muni bonds are bought up the day they are issued, held by these investment giants, and never trade again. The result, once again, is less liquidity and visibility into the market than many people are used to, and this is key to understanding and evaluating muni bond ETFs. So to put ETFs in context, let's briefly consider all the different ways you can invest in the muni bond market. You essentially have four major choices as an individual. You can buy individual bonds, you can buy mutual funds, you can buy closed-end funds, or you can buy ETFs. And I think each has its advantages and its disadvantages. The idea, at least, of holding individual muni bonds is attractive. If you're a resident of a particular state, you can buy a locally issued bond and usually have the income exempt from both federal and state taxation. Moreover, depending on the municipality, you may have a good feel for the true credit. You can follow the know what you own theory. And finally, as with any individual bond holding, you have the certainty that as long as the issuer doesn't default, you'll get all your money back at the end of the term. The problem with individual bond holdings, and it's a big one here, goes back to what I discussed earlier, which is that the muni bond market simply isn't made for you and I. There is, in fact, no muni bond market at all. Most trades are made in backroom deals for large dollar figures. So this chart shows the estimated cost of trading national muni bond portfolios at various sizes. That's the black line. You can see that it's just ridiculously expensive to buy $10,000 of a muni bond, with costs on both sides measured in the 1.5% range. That cost decays quickly as you move out the curve in size, approaching zero for $10 million trades, but for individuals, buying individual bonds can be cost prohibitive. So because muni bonds are so hard to trade, you rarely see the kind of direct buying that you do in the treasury market. Instead, investors often turn to muni bond mutual funds. Now, muni funds, like all funds, pull together a group of securities to offer diversified access to a given market. And because they tend to have significant assets and access to institutional trading desks, they can mitigate the concerns about trading individual holdings, giving institutional access to everyday investors. But muni bond funds are not without their drawbacks. For starters, any muni bond portfolio, and this includes ETFs, takes on outcome risk for investors. Because the portfolios never mature, you're not guaranteed to get your money back at some point in the future. Rather, the value of a muni bond mutual fund 1 year from now will be determined by the prevailing interest rates at that time. The lower the rate, the higher the value of the fund, and vice versa. The other major drawback is high costs. According to the ICI, the average cost of a muni bond mutual fund was 1.05% last year. That's a lot when you consider that most muni bond funds move less than 10% in a given year, meaning expenses eat up more than 10% of your return. Those costs are also high compared to other basket vehicles such as ETFs, which have a simple average expense ratio of just 28 basis points. Closed-end funds average about 44 basis points for national, unleveraged closed-end funds. On the flip side, It costs nothing to actually buy muni bond mutual funds. There are no commissions. You can buy and sell the funds at their exact net asset value at the end of every day with no questions asked. Or maybe there should be questions asked, because I think one of the most important things about muni bond funds is understanding how they are priced. All mutual funds, by law, must at the end of the day calculate a net asset value, or NAV. They do this by summing up the value of all the holdings of the fund and dividing by the shares outstanding. It's pretty easy. If it's an S&P 500 fund, the fund will see how much GE, IBM, Cisco, etc. it owns, and what today's closing price is for those securities, and away they go. But remember that muni bonds aren't like stocks. There is no single exchange or consolidated tape to look at for pricing. So there's nowhere a fund can point to and say, aha, here is the value for this particular Virginia muni bond. To get around this, muni bond ETFs rely on pricing services. These are typically issued by large bond dealers that have access to information about who's trading what in the bond space. They use this information to essentially guess or estimate where other bonds should be trading. It's often called matrix pricing because it uses matrices to estimate the value of non-traded bonds. To calculate the net asset value of a mutual fund, then, a muni fund issuer will use price estimates for each bond and then sum that up to equal the fund's NAV. The underlying securities aren't actually trading at the levels that the muni bond fund is using to estimate those prices. They're simply getting algorithmic estimates from the matrix pricing services. But nonetheless, this is the price that determines where you can buy and sell a muni bond mutual fund. So investors looking for a bit more juice in their muni bond portfolios, or those who want to trade on an intraday basis, sometimes turn to closed-end funds. Closed-end funds are exchange-traded instruments like ETFs, but they come with a twist. They issue a fixed number of shares, and it is very difficult to issue or destroy new or fewer shares. As a result, the price of a closed-end fund can differ from the true underlying value of the portfolio based on supply and demand for the fund itself as opposed to its underlying holdings. This can be attractive for investors. One of the major things investors like about muni bond closed-end funds is that they often trade at sharp discounts to their net asset value. This chart shows the average premium and discount of all closed-end funds, and you can imagine that muni bond funds replicate it pretty similarly. When funds are trading at a discount, it has the advantage of driving up the yield, so you can get a higher net payout in a closed-end fund trading at a discount than you can in a mutual fund. CEFs can also use leverage. But the premium discount issue is a double-edged sword. Because you can neither create nor destroy shares of a CEF, a fund can trade at a premium and discount for a long period of time. Moreover, that level of premium or discount is variable depending on the demand for the closed-end fund itself rather than the value of the underlying bonds, so you never know exactly what price you're going to get. Muni bond ETFs triangulate between mutual funds and closed-end funds. Like mutual funds, it's always possible to create or destroy new shares of a muni bond ETF through the authorized participant creation redemption mechanism. This means that the fund should not trade at substantial, persistent premiums and discount, as closed-end funds do, because the number of shares isn't artificially limited. There is, however, a big difference. With a mutual fund, you can buy and sell at net asset value at the end of every trading day by sending cash to the fund issuer. With an ETF, things work differently. At any given moment, the share price of an ETF is dictated by the demand for those shares in the market, just like a closed-end fund. If the price gets out of line with the underlying net asset value, more shares can be created and destroyed, but only by institutional investors called authorized participants, and only in chunks of 50 or 100,000 shares at a time. Moreover, the way those new shares are created and destroyed is different than in the mutual fund space. Typically, in a mutual fund, a shareholder will send in cash, and the mutual fund manager will put that cash to work. It is, from the investor's perspective, frictionless to enter. In the ETF space, APs do what's called in-kind creations and redemptions, meaning if they want to create 50,000 shares of an ETF, they will buy up all the underlying muni bonds that the ETF wants to hold, send them to the ETF issuer in exchange for an equal value in ETF shares. Conversely, if they want to redeem 50,000 shares, the ETF issuer will pay them the equivalent value in muni bonds, which the AP can then sell on the open market. This process works great in equities, but in muni bonds it has some challenges. Remember that earlier slide showing how difficult it is to trade munis? Well, APs have to execute those trades before they can process these creations and redemptions. This raises the barriers to doing those creation and redemptions, meaning muni bond ETFs, because the underlying securities are illiquid, tend to trade at larger premiums and discounts than ETFs in other areas of the market. Those premiums and discounts are contained compared to closed-end funds, but they're larger than they are in equity ETFs. So where does this leave you? Well, buying individual bonds is enormously difficult, costly, and complex. Most investors will end up looking at an analysis like this and decide they either want the high predictability of mutual funds, regardless of liquidity and cost, or they'll accept the variation in trading for the high liquidity and cost and low cost of ETFs. Now, once you've decided you want a mutual fund or an ETF, we get to the age-old question in bonds. Not just muni bonds, but all bonds. Do you go with an index fund or do you go with an active fund? Both are available in ETFs and funds, and both have their adherents and their detractors. The majority of ETFs track rule-based indexes. In the case of munis, these are often constructed by defining a selection universe, such as all the muni bonds in the ETF, and then selecting those bonds that exceed certain thresholds for issue size, and then you weight by the amount of debt outstanding. While a similar framework makes sense for stocks, it runs into pitfalls in the bond space. For starters, as mentioned, it can be challenging to replicate these indexes due to the utter illiquidity of the underlying securities. But more importantly, to my mind, the nature of market cap weighting in the bond space means that you invest the majority of your money in the most indebted issuers. Think about that for a moment. By definition, muni bond indexes and all bond indexes invest the largest share of their assets in the most indebted issuers. And even if you do not think California or New York or various other municipalities will actually default, headline risk can often impart more damage to a portfolio of muni bonds than real default ever will. As such, national muni bond portfolios expose investors in large amounts to bonds from states that they may not want exposure to, simply because market cap weighting pushes them in that direction. By comparison, active managers do not have to follow these rules. A smart manager can utilize his expertise to navigate the inefficiencies of the market. They don't necessarily have to pile into the most indebted issuers. Of course, achieving strong active results is difficult. It's also not free, and active funds tend to have significantly higher costs than index products. Additionally, the active manager's portfolio may not, in fact, be highly correlated with the muni bond market, so you can reduce your beta exposure that you're trying to achieve. Still, I do think it's worth noting, and I work for IndexUniverse, but I think it's worth noting that almost 2% of money in muni bond ETFs is actively managed. This is not resounding, but it's about 20 times the percentage of AUM in actively managed equity ETFs on a percentage basis. I do think there's more room for active in this space than in other areas of the market. So with all that money indexed to the most indebted issuers, you have to ask yourself, can it all be wrong? And it really depends on your perspective. In bond index funds in general, but in ETFs in particular, I think you should think of indexes as more of a suggestion than a rule. The reason is that muni bond indexes were not designed to be investable. As mentioned, the market for muni bonds is inefficient and opaque, so few issues actually trade regularly and some don't trade at all, as we mentioned. Because the holdings of a typical muni bond index has over 1,000 holdings, ETFs will always be handicapped in their ability to replicate their underlying index, as liquidity will restrict them to a few hundred of the thousands of securities in the index. ETFs face larger challenges here than competing mutual funds, as they must create a focused basket for creation-redemption activity. RIC compliance issues will further complicate matters. As such, you see massive optimization in the muni space, as shown in the slide, and this can lead to higher than expected tracking error. Here's just one example, comparing a popular muni bond ETF covering a unique area of the market, pre-refunded munis. This is actually an excellent fund providing unique exposure to a difficult-to-access market, but you can see that over time the fund has deviated from its index. Now that could flip-flop, the fund could beat its index, but it does show that tracking error is a real risk in this space. The biggest issue that people stumble on in muni bond ETFs, however, is premiums and discounts. Now, many of you have heard me say 100 times that the underlying liquidity is the biggest determinant of ETF liquidity, and we now know that muni bond liquidity stinks. Now, this becomes a real problem for muni bond ETFs in times of market uncertainty, such as November 2010, which was the heart of the muni bond crisis. This chart compares the trading price for MUB, the National Muni ETF from iShares in green, with the indicative NAV of the portfolio in black. And you would expect these lines to track one another as they did in the first days of November. But look what happens around November 9th. The price of MUB craters while the indicative NAV stays flat. At one point, a gap of nearly 5% opened up. Now, there are two ways to interpret this gap. One would be to argue that the fund got it wrong. Investors sold aggressively out of the fund, and due to the illiquidity of the underlying portfolio, APs couldn't arbitrage the difference. By this reading, the fund traded to an artificial discount, and investors who held the fund got hurt if they sold. But the flip side, and an equally convincing argument, is that the Muni ETF got it right, and that its deviation from the underlying index is a symptom of price discovery, not true premiums and discounts. Remember that that black line, the NAV, is driven by matrix pricing, not realized prices in the marketplace. And in times of illiquidity, NAVs can become stale. There's substantial anecdotal evidence of serial correlation in bond matrix pricing. So you might expect these two to differ. Which one's got it right? You be the judge. One way that issuers have grappled with the premium discount problem is to systematically allow APs to process creations and redemptions with cash. That way, APs can just send cash into the issuer, who will then put it to work. This chart compares the premiums and discounts of two ETFs, MUB and TFI, from March 2009 through present. Both cover the national muni space. The funds differ in a couple of ways, but the biggest is that State Street's TFI allows cash creations, while MUB uses only in-kind. You can see that the red line of TFI rarely ticks above 0 on the premium chart, while MUB does regularly. Currently, State Street, VanEck, and Grail allow cash creations on muni bond ETFs, while BlackRock, PowerShares, and PIMCO do not. Generally, those that accept cash creations require in-kind redemptions. That's why you don't see any cap on the redemption side. So why doesn't everyone allow cash creates? I think a couple of reasons. First, in-kind creations are tremendously efficient. The fund doesn't have to take in cash and then deploy it in the market, which limits trading costs, commissions, etc. Second, cash creates have the potential to raise tracking error if securities are purchased at a different price than that reported in the index. So let's quickly go through some of the key benefits of ETFs and why people use them, and then we'll move into the Q&A. Obviously, intraday liquidity is a key benefit of ETFs. ETFs are more liquid and trade at tighter spread than closed-end funds, and compared to mutual funds, you can get in and out at any point during the day. That can be a big advantage for people who want to make market timing calls. The second, as mentioned, is price discovery. ETFs are now acting as a guide for muni bond pricing. Moreover, the action of creation redemption in the ETF space is driving substantial liquidity in a select number of underlying bonds, improving actual pricing as well. I think this is one of the real changes in the muni bond industry that ETFs have driven. And this slide just shows that ETFs have been a major success. I'll admit when the first ETF launched in 2007, I was very skeptical. I thought people didn't want to trade muni bonds, and mostly they wanted to drip money into mutual funds, which doesn't work in the ETF structure. But that first fund, iShares MUB, has grown to be a $2 billion fund, and State Street's TFI is now $800 million. All told, there are now 31 ETFs with more than $7 billion in aggregated AUM, and they're covering every segment of the market. You know, whether that's points on the yield curve, whether it's high yield, whether it's Build America bonds. Really, you can access any area of the market with muni bond ETFs and start to do some tactical allocation in the ETF space. This chart just shows some of the flows. We heard about $44 billion flowing out of muni bond mutual funds. ETFs have done much better than that, consistently having significant inflows right through the start of the crisis in November, December, and January, when they reversed temporarily, having about 200 to 300 million in outflows a month. But those have turned around recently, and I think the inflows will continue. My last slide, I just want to talk about how you evaluate a muni bond ETF. And as many of you know, here at IndexUniverse, we use our ETF evaluation system for efficiency, tradability, and fit. Efficiency looks at how well a fund delivers on its core promise. And because many index muni ETFs are highly optimized, you can see significant tracking error. The portfolio sensitivity to interest rates and credit risk relative to the index should be closely monitored. This can be challenging because the data is not perfect that's out there, but you should take a look at the underlying portfolio to see how heavily optimized it is compared to the index. Second, on tradability, this is a bigger deal in muni bonds than it is in other areas of the ETF market. Funds with the highest quality portfolios are most likely to trade at the tightest spreads. Funds that allow cash trades should also have slightly lower spreads, and certainly the premiums and discounts should be tighter, but they have other issues. I want to just emphasize here that we do see higher spreads in muni bond ETFs than other areas of the market, so you should trade with particular care when you approach them. And then fit is the last piece. Fit looks at how well a fund captures beta exposure to a given area of the market. So if you're buying national muni exposure, does this fund capture that exposure? And all I can suggest here is that you truly dig into the benchmark, see how it is constructed, and ensure that that construction aligns with the take on the market that you want to have. With that, I do want to leave some time for questions, so I'm going to wrap up and bring Matt back into the equation. You know, Matt, you talked a little bit about the role of ETFs and why you think they're a good vehicle for cost reasons. I guess I wanted to ask you two questions, and then we'll go to audience Q&A. The first is, how do you think ETFs have changed the muni bond market? And the second is, what's your overall take on the advantages and disadvantages of active versus passive exposure in the muni bond market?
Okay, well, to take the first, you know, the ETF market has definitely grown quite a bit, and you know, like you were saying, we're at several $1 billion, up from zero only a few years ago. But you know, really in context, they're still a very small, you know, compared to other forms of asset or other forms of ownership allocation. So, I mean, I don't think that ETFs themselves have had that much of an impact. Directly. Although the one thing is that the intraday pricing that is available to the ETFs. The intraday pricing that is available through the ETFs has given people maybe a bit more insight into where you know, the market is going midday, which has always been a problem. So maybe it has had an incremental benefit to trading liquidity. And then, you know, active versus passive, you know, in today's market, I think that the difference is much more extreme than it had been. You know, we have, because there is such a premium being placed on high-grade securities in particular, you know, highly rated AA and better with, you know, shorter maturities and more defensive coupons. Those kinds of bonds are trading at, you know, much wider or much tighter than you know, non-high-grade bonds. So, you know, when you go with a pure passive, you know, you are in a sense, you know, sort of swimming with you know, the crowd pursuing those high-grade bonds, and you know, while your performance, you know, will still be acceptable, but you know, you do create, you are providing less yield and less income to your you know, to your own clients. You know, when you go with a managed, and you could take a bit more risk, and you know, you swim out a bit from the crowd, you can bring in, especially today, even with a, only moderately going, down the credit scale, you can bring in tremendously more yield, to the end client, just because there's such a difference these days between high grade and non-high grade. So it is, really worth considering, in particular in today's market, taking that calculated risk, can add substantial tax-exempt income to the account, which is, really after all what you're being paid to do.
Here's one question for the audience, which I'll actually throw it to you. It mentions that we have high yield and BABs and state-specific muni ETFs. Do you think there's room for further fragmentation in the products? Do you think there's, for instance, room for a GO-only muni bond product, or is that getting too specific for investor needs?
I think at this point, I think that it probably already has gotten a bit too specific. There are, I think, too many ETFs out there as it stands. Now, I'm not an ETF, expert, so probably there could be, perhaps the market could support, a larger number. But it seems to me that you have 2 or 3 of the ETFs, represent the lion's share of the total ETF assets. Those are going to have much better liquidity. The others are, in a sense, swimming upstream to compete. I just think that it's harder. I mean, I don't fully understand how an ETF market develops, but it seems to me like there is already, maybe a bit too much granularity, in particular among the smaller ETFs.
I think I'll just add my 2 cents. I think that's probably fair. I do know that there are significant filings for additional state-specific ETFs. I think liquidity is of course an issue there, but I wouldn't be shocked if we saw New Jersey or Virginia or other major municipality issuers have ETFs tied to them sometime in the next few years. I've been surprised by the pickup of some of these fragmented sections of the ETF market. I mean, BABs have been a runaway success in the ETF market. That market's obviously going to change. But it does show there is at least some audience for them, although fragmentation obviously is a risk, and fragmented liquidity makes them less appealing.
The only risk in general with, even with open-end funds, is that in general when you go to state-specific, if the fund itself is too small, and it's harder for any manager to fill a state-specific fund these days, just because supply is down and there just isn't a lot of product floating around. You could be picking up undue risk to Puerto Rico, because Puerto Rico, as triple tax exempt, can be fit into any state-specific fund. So and Puerto Rico does represent a more undue credit risk than other credits in the business. So you do need to be careful about any state-specific fund's exposure to Puerto Rico.
Very interesting. Let's talk specifically about the issuance being down. We have a question from the audience asking you what you expect to happen given significantly lower issuance coupled with demographics of an aging investor community, coupled with the potential for higher taxation. Is there not sort of a perfect storm of muni bond supply-demand imbalances coming down the pike?
Well, I think that's what we're seeing. It's being negated to an extent by investor trepidation over credit. People are more worried about credit than they have been in a long time. So they're not allocating as much to munis. They're seeing more risk per return. But looking at the supply. Supply is down drastically this year. There's really 3 things at work. In sort of the near term, what we have is just a splashdown from a recovery from the BAB program. BABs, they didn't actually induce much new issuance, but they did accelerate a bunch of issuance out of the future. This being the future, those bonds have already been sold. So the BAB product did take away issuance from this year. You also have issuers, adopting new austerity. An awful lot of new governors, have come in, and just in general, when you're trying to balance state budgets, most muni issuance finances new projects as opposed to maintenance of old projects. So So the need for new issuance, really depends on your interest in doing new projects, and new projects are easily curtailed when budgets are tight. So issuance is down, and the third factor is, what I alluded to before. There's the three things that had really helped keep interest rates lower in the past: bond insurance, derivative transactions, and leveraged buying programs. All three of those have been crippled by the financial crisis, and are probably not coming back in any recognizable form in the near term. So those are pushing interest rates up, credit spreads wider, so issuers are facing a bigger penalty in coming to market than they had been before. And there are probably a large number of issuers who had gotten into our market only because of those three products: smaller hospitals and private universities and more speculative transactions, and they may just not be coming back. So they may in the future may just need to be seeking private loans from banks or other investors, as opposed to coming into the bond market. So we're probably at a lower baseline overall for issuance, and in particular, while this austerity persists, which could be years from now, we'll see continued low issuance. Investor demand should be strong, but investors, as long as they're worried about credit, are going to continue to favor high-grade, highly rated bonds, which means structurally wider credit spreads, and from my perspective, structurally better opportunities to add income, at only nominally increased default risk.
Interesting. And we have time for one more 60-second question, and I'll make it a big one, and then we have to wrap up. If you think fears are overblown on the default space, and you presented some interesting data there, why do you think that's such a topic of discussion? And could those fears be realized in the near term, or is it simply unbacked up investor trepidation?
Well, I mean, frankly, I think it goes hand in hand with general anti-government, anti-tax sentiment in sort of the broader political world. People are pushing back at what they see as excessive employee benefits, excessive taxes. When you think about governments doing those things, in effect making mistakes, the implication is that municipal managers are doing a poor job, and so therefore you do fear default, and that they will make a mistake to hurt investors. So, I think as long as this, the Tea Party dynamic, the anti-tax dynamic persists, in general the anti-government dynamic persists, you will have more fear of, towards the municipal bond market in particular. So I think this is something that is also probably a phenomenon to be with us for at least the medium term. But how the muni market works, the structure of the security, it just doesn't bear out those fears.
Great. Well, thanks, Matt. I appreciate you taking the time. I appreciate everyone listening in. For more information, I invite you to go to either Matt or my website, IndexUniverse.com or MMAresearch.com. As participants in this webinar, you are eligible for CE credits. We will be sending out an email in the next few days alerting you to where you can listen to a replay of this webinar or download the slides, and also how you can qualify for those CE credits. Thanks, everyone, for joining us this afternoon. I hope you appreciated it. We'll see you at our next Index Universe webinar series in a few weeks. Thanks very much. Have a great afternoon.